Obviously, Telstra is a really big company in Australia, and they reported recently very strong results. The three key things that I really thought about when I looked at the results and having sat with management during the analyst briefing was that the first one that what management said was they declared that the results were in line with guidance, but also they made a big declaration, and they've been doing it for the last few halves now, saying that this is their turning point in their financial trajectory. And where they see their next year in terms of earnings guidance was that underlying EBITDA should be about 7 to 7.3 billion, and that really represents high single digit growth, and that's really important to note because, as you know, for the longest time, Telstra has been, investors have been really critical of Telstra and their performance. The mobile business has been doing really well, but the legacy business in the fixed line business, as well as their separation of the NBN, has obviously not gone to plan in line with investor expectations. So that's a really nice outcome for their result, that they're returning to high single digit growth, and the second point that I would make is that on the conference call with the Telstra management team, they spoke a lot about how they're continuing to execute the T22 strategy, and they provide this really big table for investors to have a look at. And 80%, what we realize is that 80% of the scorecard they've already achieved, and so they're looking for really nice cost reductions off the back of that, and they're on track to meet a target of 2.7 billion by next year. So a really great outcome. The third point is they've announced a on-market buyback of 1.35 billion, and that's just off the back of selling part of their towers business. It's the InfraCo sale. And that really should support the share price. Every time you see an on-market buyback, it means that the company has assessed a whole range of capital management initiatives. They've thought about paying out more dividends. They've thought about injecting that money towards project that they can undertake to deliver more growth for the investor. Or they simply can do a on-market buyback, thinking that that's the best means to improve shareholder returns. And the point there is also that that really underpins their share price. It means that the company is confident in what they're doing, such that they think that out of the range of capital management initiatives, they think that buying their own company is going to deliver the best returns for shareholders. Obviously, what this company has done in the past, we take with a grain of salt, but we upgraded the company to a buy recommendation because when we analyzed it, it really is on the precipice of something better than what they were previously. That table was essentially a table showing their valuations. These are consensus numbers, and on a 1 year basis, it doesn't look that attractive. 28.1 times. On a 2 year basis, 23.9 times, and on a 1 and 2 year basis, they're at roughly about 4% dividend yield. And you can see the share price performance there over the past year. It's really reflected in this reversion of their financial performance from yesteryear. They're up 29.8% over the last year. Again, off the lows of when the coronavirus happened, but at the same time, it's a good reversion for this company.